Hello, this is the Unemployed Value Degen. It's been a couple weeks since I last checked in here. I've had a bunch of life events. I even got called in for jury duty. But the 10-year Treasury is finally coming down. It's down to about, give or take, 4.25. And that's fantastic relief. It'd be interesting to see how long this channel holds, and if we really do end up seeing maybe a 3.5% 10-year Treasury some point within Trump's first 2 years of his administration. Because I still believe a 3.5% 10-year Treasury gives us a chance at a 5.5% 30-year mortgage, and the housing market would go a long way to unthawing if we get a 5.5% 30-year mortgage, and we could be there. You had both Trump and the new Treasury Secretary, Scott Bessent, both said that getting the 10-year Treasury rate down was a top priority. And it's falling, and we'll see what kind of policies they can put in place to keep that happening. But yeah, that's the momentum now, and it's definitely a bit of relief, especially because the stock market's been selling off, and a lower 10-year Treasury could really go a long way toward helping the stock market rebound. Now, the dollar index has been a little bit stronger. It's even rebounding pretty solidly today. So just compare what's been happening recently. I mean, the dollar weakened, what is this, from the end of December to now. The dollar's been weakening a little bit, but it hasn't been following the Treasury as closely as you would think, because typically one of the things that moves the dollar index is going to be interest rate arbitrage, right? And so interest rates being higher in the US would mean people would want to bring their money here, and it would strengthen the dollar. People taking money out of the US would weaken the dollar if they have better interest rates in their home country. But I think that the Magnificent Seven, being able to invest in Nvidia, people have been selling their currencies and buying dollars just to be able to participate in the artificial intelligence revolution. And I don't know, as it's going to be tied to the Magnificent Seven, I don't know how well that's going to be slowing down. So, in fact, maybe that's not the best. Let's see, can I clear that? Let's see. Let me go ahead and draw this line. So this period of past resistance here, there was a technical analyst I saw from Canada who was arguing that this past resistance peak could become support, and they were predicting that the dollar index would bounce off of this line and then start going higher again. And there is a threat of that. There is a threat of the dollar staying strong, and that would really make it difficult for commodities and for international stocks. But for right now, it's not obvious which direction it's going to go, but it's kind of at a critical spot, especially if you saw the 10-year Treasury continue to fall, but the dollar index actually rally. That would be quite a divergence. And again, what would be driving that is people selling their currencies in order to buy assets in the US, but not necessarily Treasury bonds. All right, and then the Fear and Greed Index. We are at extreme fear. We're even a good chunk of the way into extreme fear. I mean, the S&P 500 hasn't even sold off that much for us to get into extreme fear. Let's look at the timeline here. It takes a little bit to load, yeah. So since that Treasury meeting where Jerome Powell kind of spooked the market, we haven't been over 50 on the Fear and Greed Index since the middle of December. And now we're at this, extreme fear, which we were only at one other time in the last year, and that was last August. So this is extremely bearish territory. And if you have any dry powder at all left over, when you see the market at extreme fear, you need to just run out and buy something, right? Find something to buy. Raise some cash and find something to buy. That advice serves people well. Find a good company below its 200-day moving average. Buy it when the market's at extreme fear, and you'll do okay. Breadth is deteriorating again. Breadth had rallied all during January. I think there was a lot of tax loss harvesting in December, and then people rebought into those positions. And all throughout January, it looked like maybe we'd be entering this period where the market breadth would be improving. And now in this sell-off, it's crashing again. We finally have a situation where people are buying puts again. And one of the nice things about people buying puts is because of the gamma and the delta hedging, that actually stops the market from falling, because the market makers have to go in and do some buying in order to manage their risk from the put buying. So the more people that are insured from the market falling, the less likely it is to fall. And this is telling me that the put call ratio getting pretty high here tells me that you know, if the bottom's not in soon, but the bottom could be in relatively soon. And you have the VIX. Is it over 20 today? I can't see today's, but yeah, the VIX might just be creeping up to 20. And anytime in a bull, if you're in a bull market and the VIX is over 20, it's a good time to buy. If you're in a bull market and you're in extreme fear, it's a good time to buy. So this is a fantastic time to buy something. I don't have any dry powder. I'm completely invested, and it has been a rough couple of weeks for me. But yeah, this is a fantastic time to go into the market and buy something. This is the 1 month Morningstar style box, and you have huge sell-off in everything except for large cap value. And that's a flight to safety, right? People are selling things and they're buying Hershey's and Coca-Cola and things like that. Things that they know, you know, no matter what happens to the world in the next 10 years, those companies are going to have value. So a sell-off in small value and small growth and large growth, but buying in large value. Let's see. I changed the chart up a little bit. I put the 50-day, the 100-day, and the 200-day moving average. And the S&P 500 now has been grinding lower. In fact, let me make it shorter term. Let's just look at the 3 months. All right, so this recent sell-off since the middle of February, it's moved below the 50-day moving average. It's now below the 100-day moving average, although it looked like that was acting as a little bit of a resistance or a support line. But we're still nowhere near the 200-day moving average. Right, I mean, this bull market has been so aggressive in the S&P 500. We're still 20 points away from the 200-day moving average, and if you look at where the RSI is, you know, it's almost to the oversold territory. I don't think it has enough momentum to come close to this 200-day moving average line. And there was nothing fundamental. This seems more like just a pure, you know, momentum sell-off more than anything. Just, you know, every certain number of months the market sells off 5 or 10%, and it seems like that's what we're in. But I think this is going to peter out well before it hits the 200-day moving average in the S&P 500. But what's happening to the equal weight? All right, equal weight is a much less attractive looking chart, where the S&P 500 has still been making higher highs, but slowing down, right? So the S&P 500, you have a higher high and you have a higher high. So there's, some people could argue that it looks like it's rolling over, especially because it's nowhere near the same trend line that it was, you know, earlier in the year, give or take, something like that. So the rate of change has slowed on the S&P 500, it appears. And this could be a period of consolidation, right? That could be just one giant bull flag or something like that is very possible. But it also could be a sign of rolling over. I would be much more likely to believe for the S&P 500 consolidation than rolling over, but at least you still have some higher highs here. But you go to the equal weight, and the equal weight is much less attractive, right? You don't have any of the higher highs. If anything, you've got quite a resistance line. Now you have a double or a triple top here, which is not an attractive thing to see. So you don't really have much anywhere near as much of an attractive story. Now, still in this sell-off is even a little bit more gentle. You're barely below the 100-day moving average, and you're still a good long ways away from the 200-day moving average. And The RSI is not quite as oversold here. So it seems like the equal weight S&P 500 has been holding up better. And I think that's why the sell-off seems to be Magnificent Seven driven. So this is the NASDAQ. Well, actually, NASDAQ is large tech and small tech. Let's just look at the big tech ETF. Yeah, so the Round Hill Big Tech ETF, right? It looked like this was some sort of maybe a bull flag with some consolidation, and that would mean, hey, the next way is up. But this last 2 weeks, this recent sell-off is a very different pattern. I mean, this is broken out of that trend. It is this area here. Let me zoom in a little bit. Not out to 3 years. Let's go to 3 months. So this area here for all of February, where it's spending all this time below the 50-day moving average and not really able to hold above it, and then the 50-day moving average rolling over and starting to be on the decline. That's not an attractive graph, and this is for the Round Hill Big Tech ETF. So the Magnificent Seven are showing some weakness, and I think probably well deserved. But the NASDAQ includes large tech and small tech, and the NASDAQ does look a lot better. The NASDAQ is still kind of within this consolidation period. You could look at the NASDAQ and say, yeah, that's consolidation after a bull flag. Right, so the NASDAQ is still somewhat more well behaved. I think that's because small cap tech is starting to carry the day. So if we look at the ARK Innovation ETF, this one I'll go back. Now, this is a rough couple of weeks, but you're still, and I'll talk about this in just a little bit. Let's go to 5 years. So this is Cathie Wood. This is that 2021 enormous rally when she became famous and was interviewed on CNBC every other day, and then it came crashing back down, gave it all back, and just came all the way, just a 2-year round trip, and then this consolidation period for 2 years, and now it's starting to rally again. But if I look closer, if I go back to the 1 year, this crash here, it's just the 50% retracement of this run up, right? So the distance from 47 to 68 back down to 55, that's just the 50% retracement of this massive rally. That's a totally healthy thing, and I think small cap tech, it's so oversold. You have ARK itself getting into oversold territory, and I don't want to comment on her small cap tech choices. I dug through her holdings and I didn't find a lot that was attractive to me, but I'm not a tech expert. I think the only overlap is I want to say Schrodinger's, which is a company that does machine learning to discover new drugs. Anyway, I don't want to comment on our individual holdings, but just small cap tech as a group, I think has enormous potential for the rest of the year and maybe next year too. I think that might be one of the top performing categories, small tech. And let's check out the Russell 2000. That's not a pretty chart. The Russell 2000 is below the 200-day. There was no, and I think that might even be correction. From 242 to 213, yeah, this is more than a 10% drawdown from December. So the Russell 2000 is in correction territory. That's disappointing because I'm a small cap value degen, so I hate to see small caps in correction. Although the Russell 2000 is not a perfect representative sample, it has a lot of biotech in there. And that behaved very differently because of the RFK Jr. nomination. But still, it's people use it as a proxy for all small caps, and it's ugly. It is painful, and people look at the overall market and say, well, the S&P 500, how big of a correction is it to go from 611 to 587? That's not even that big of a correction. How big of a correction is that? 4%. So people say, oh, it's a 5%, 10% correction. You're expecting one of those a year, give or take. And we had a pretty good size one last August. So We don't have to have a 5 or 10% correction, but I think that kind of is hiding the fact that a huge chunk of the market has been sold off mercilessly. The Russell 2000 is in correction territory, and it is painful. And this earnings season, right? I mean, some companies, I mean, very decent companies with very reasonable results have just been taken out to the woodshed on earnings calls. A great example of this is Materialise. I just wrote about it, and on earnings it got knocked down 40%, and it's still crashing further. And the fundamental story of the company is, I think, very decent. You know, I think it has a good market position. And I even, on my write-up, I said this current quarter is going to have bad results because of the growth CapEx, building out a new facility in the United States, which has enormous potential to do 3D printed medical devices. You get a custom hip implant or something like that, so you have a faster recovery rate than a standard piece. But if the market doesn't like something during this earnings season, it really doesn't like it. And the same thing was true for Newell Brands, right? That earnings, it went from $10 to $7. That was down to $6.30. So in small cap, and this wasn't even a small company. I think it was more close to a $3.5 billion market cap, which I don't even consider to be that small. But this earnings season, if the market didn't like what it saw, it's just been unforgiving, just totally merciless the way you'll get treated this earnings season. It's incredible. People are trying to come up with the reason for this sell-off. And some people have called it, a rolling over the momentum factor. Some people have called it degrossing. I don't think it's been degrossing because I have a couple of stocks that are on the most shorted list. And during most of this sell-off, let's go back to the IWM. So during this last 2 weeks, people have been calling it hedge fund degrossing. And the thing about degrossing is people would close their longs and their short positions. But my shorts, the prices, or the companies that I own that are on the most shorted list, their stock prices have been falling during this period. So people are not closing short positions. So it's kind of bugged me on the news. Everybody's calling it degrossing this and degrossing that. But that is not what's been happening, except until today. And I think a lot of this is earnings related. But this might be the first day of the last 2 weeks where it really is degrossing, because two of the stocks that I have are on the most shorted list. RILY Financial, look at that. It jumped from, I think this was $2.77 to, it was over $7 today. And then Medical Properties Trust, a similar story. It was from under 5 to 5.5 in one day. This is the first day of this 2-week period where companies on the most shorted list are having these righteous squeezes. So even though people have been calling it degrossing for a couple of weeks, I think this is really the period where the degrossing is actually happening. Now, Medical Properties Trust had an earnings call. I think I'll do another write-up on this, because I did a write-up on my Substack called Medical Properties Trust, the Endgame. Because it seemed to me that the shorts, they didn't have a thesis left. Any of their complaints about the company had been resolved. But on the last the earnings call that was today, one of the claims that the shorts had made is that they won't be able to refinance their debt, and that all their assets are encumbered. And management clarified that they have, I think, between 5 and 6 billion of unencumbered assets. So even though they have enough cash to cover all debt maturities through 2026, by the time 2027 comes along, they have 5 to 6 billion of unencumbered assets that they could do secured lending against. So that there's really no refinancing risk, there's no bankruptcy risk, there's no reason for this company to trade at half of tangible book. And I think that's more responsible for this short squeeze. The last 2 times it got up over 6 on a short squeeze. And I think this is a company to watch for the next couple of days, especially for it to be up this much on a day when the market's down is pretty impressive. And it's still, I think, half of the float short. I can check on that quickly. Medical Properties Trust. Yeah, I'll have to do another write-up on this, but I think the short thesis just doesn't have a leg to stand on. Okay, it looks like there was some short closing recently. It had been up to 45% short float, and now it's down to something like, 40% short float. But still, to be 40% of the float shorted on a dividend paying REIT, a real estate investment trust that's trading at half of tangible book and has no bankruptcy risk and no refinancing risk, that's a pretty ridiculous situation. And you can see the last two short squeezes on here. And but this time I'll be curious to see, one is how high it squeezes if this is the start of a short squeeze, and two is where the price settles out at afterwards when there's some more price discovery. The quantitatively driven shorts might still stay in it, because on this earnings call there was still an asset markdown. So I think GAAP, generally accepted accounting principle, net income will be negative for the quarter because of an asset markdown. But this is a company where the rent they're receiving from their properties, is more than enough to cover the interest payment on the debt and to pay a dividend. So I can't imagine why anybody would be short this thing. RILY is a different scenario, and I'm going to have to probably write this one up again. That's quite a breakout from this consolidation period. And I think I had bought some shares of RILY in the 20s thinking I was very clever, and then I just about doubled my position somewhere down here in the 4s. I haven't written about it on my Substack for a long time. Both B. Riley and Medical Properties Trust are heavily shorted, and the difference between the two is that B. Riley is they're a small cap merchant bank. So they'll do underwriting for bond issuances and for IPOs and for mergers and things like that. And this small cap merchant bank, well, to be a merchant bank, you kind of live and die by your reputation. And when I was more naive about short sellers, I thought, well, they have a different opinion. They're trying to uncover the truth. They're looking for price discovery. And that's not what a huge chunk of short sellers in the market do. What a huge chunk of short sellers in the market do is they just defame the institution, calling them a bunch of frauds and saying they're going to be arrested any moment, and try and damage their reputation. And in a situation where it's a financial firm, if you damage their reputation enough, you could actually destroy the business. And that has happened to B. Riley. There's been enough reputational damage that they had they were trying to grow into financial advising. And they had to sell that business for a tiny fraction of what they bought it for, because their financial advisors were leaving, because you can't get new clients and you can't maintain relationships if when people look up your company online, all they see on Twitter is people calling you a fraud 1,000 times a day. You just can't operate that way in a world with trust. And so it really is a case where I think the shorts are trying to destroy the business as opposed to the shorts finding a bad business. But meanwhile, even with this attack, they've been able to operate. So if I go to B. Riley, what's really interesting is they have been able to land new business. So if I go to their, somewhere on here, there is recent transactions. And so they have been able to, right? They were the sole agent for an at-the-market offering for Secor Marine, a distribution agent for BitDeer, a book runner for Priority, co-manager for a convertible notes offering for AST Space Mobile, joint agent for D-Wave, distribution agent for Iran, I think that's a crypto miner, exclusive financial advisor, so that they have a consultancy service for travel traders, sole agent for at-the-market offering for Eagle Point. So yeah, they've been able to a sole book runner for a $230 million, whatever that was. So they've been able to land business. The reputational damage from the short sellers destroyed their financial advising business, and I think their head of mergers and acquisitions jumped ship to a different firm, and now there's a big lawsuit over it. But the reputational damage didn't destroy their ability to be a merchant bank. And the commissions on these things, so the commissions on this activity, it's somewhere in the neighborhood of 6 or 7%. So when they're a sole book runner, let's see, sole book runner or lead distribution agent for a $100 million offering, you got to figure that company is going to make $6 or $7 million off of that. So the capital markets are open, and they're in business, and they're doing business. So the reputational damage didn't destroy B. Riley, and the reputational damage was so much. They had their primary lender was Nomura, and Nomura had asked them to pay off all the debt because they wanted to get out of the relationship. And Howard Marks of Oaktree came in to, and this is the news today, which is one of the reasons why the stock is up so much. So Oaktree Capital Management under Howard Marks came in to replace Nomura as their primary lender. So they have a friendly lender again who is not worried about the reputational risk of doing business with B. Riley after there's just these really, I think it's defamation. The people on Twitter that will say awful things about this company. And that, you know, it's a very, very long story, but they, yeah, I won't get into it here. I'll do a huge write-up on my Substack. But they have a new primary lender. They paid off the 2025 maturity of their bonds. They don't have a maturity until I think March of 2026. The capital markets are open and they're doing business. And if you go into all the assets they own, I think this is a dramatically undervalued company. So, and now it looks like it's short squeezing. The difference is, I think with Medical Properties Trust, I think Medical Properties Trust, this really is the end for the short thesis. But I think with B. Riley, I think it's going to take another year of proving results before the whole struggle between the longs and the shorts is finally over. I think Medical Properties Trust, they don't really have a leg to stand on. They had 18 cents of funds from operations this quarter, but there's a covenant restricting their dividend to 8 cents. Well, 6 months from now, that covenant will be gone, and they'll be able to pay that as a full dividend. So if they're paying out, you know, 70 cents a year in dividends, and it trades at a 10% yield, that's a $7 stock. If it trades at an 8% yield, that's an $8 stock. So I don't really see any obstacle to this $5.50 price hitting $7 or $8 before the end of the year. And on a short squeeze with 40% of the float short, it could go much higher than that. What's the short interest on B. Riley? I think it's aggressive. Oh wow, yeah, 56% short. And it was as high as 80% short in August. Yeah, so it's still 56% short. It's still one of the most shorted stocks in the entire marketplace. And two big claims of the shorts have just been exploded. One was, so Riley was also delayed in their filings, so they were at risk of being delisted from the NASDAQ. And they have since released 2 quarterly earnings statements that they were behind on, and now they're no longer at risk of delisting from the NASDAQ. So 2 of the big short arguments for B. Riley are gone, with the refinancing from Oaktree and being more current on their quarterly filings. So I'm going to have to do a write-up on this, but it's what a crazy day. But again, this is all in the context of, while, let me look at the value factor for the S&P 500. Yeah, the value factor hasn't had much of a sell-off at all, but this is large value. So let me go back to the Russell 2000, and that sell-off is very aggressive. And the argument here was that this was degrossing, that people are closing their longs and their shorts. And it just wasn't true, because the most shorted stocks weren't rallying until today. Today is finally the first day where the most shorted stocks are rallying. And that means that this is an actual, finally after 2 weeks, a degrossing event. So all right, let me jump into some of the charts. We looked at Medical Properties Trust. Usually have a lot of people ask me about New Fortress Energy. I don't talk about it often because my position is full. Now, this has been a painful drawdown, not just 2 weeks, but for the whole of February. It's come from $16 all the way back. It was in the 9s today. And the market's about to close. I'm filming this while the market is open. But that looks like a hammer candle. It's early to declare that the bottom is in. But this sell-off has been aggressive. I think they report earnings on the 7th of March, but there was nothing fundamental driving this. If anything, they acquired a new contract from Puerto Rico during this time period. So fundamentally, things are improving. There's no imminent debt maturities because they've refinanced that out. Some people are speculating that this sell-off might be driven by, somebody smart knows something and there's going to be some ugly thing revealed on the next quarterly earnings call. I think this was just... I think it was just, it's more than a 50% retracement from this rally, but I think it was just something being sold off because it's small, because it's value oriented, and those things are getting sold off right now. But I think it's overdone. The RSI is in oversold territory, and I think that is going to be at least very close to a hammer candle. Let me zoom in there. Yeah, so it's not a perfect hammer candle, but again, this is an illustration that during today, the market opened, the stock price fell, and then as the day wore on, the selling momentum was exhausted, and dip buyers came in and they bought the price back up. So it's not a perfect hammer candle, but this is a pretty strong indication that this downward momentum is over when you see a hammer candle. And if it's reverse, if it's upside down, it's an indication of the opposite. So like for here, right back in December, there was a hammer candle that preceded a large rally. It doesn't work every time, but this is a pretty good indication that this sell-off might be over. But it has been a heck of a sell-off because this is a large position for me. Even after the sell-off, it's still a 6.5% position. So that ride down from 16 to 10 was very painful. But fundamentally, things in the company are improving, and we'll see where it goes from here. Also, in the pain situation is ProFrac Holdings. Although this sell-off is much less, and today it's having a positive day by a good chunk. The energy space is green today, and some people are saying that when everything else is red, look for what's green on red days. And today, so this is February 27th, energy across the board is mostly green today. That could be a sign of a rotation into energy, which is well overdue because these companies just have enormous cash flows and nobody appreciates them. All the moving averages are getting squeezed together, which means there's room for an explosive move to the upside or the downside. But the rig count has finally started increasing again. So let me go to oilprice.com. Oilprice.com shows the rig count. And let's see, US rig count, production, no, 3 months, 1 year. Uh, 592, maybe that does show. Yeah, I don't know if this is, no, it wouldn't be delayed, it's 21st. But the total rig count has started increasing again, just slightly. That wasn't the infographic that I had seen. Let me go back to the 3-year, 5-year. So yeah, you had the rig count decreasing ever since the end of 2022. And it looks like the rig count hit a low point in January, and it's starting to increase again, right? So the rig count increasing should be good for an oil field services company like ProFrac Holdings. And we'll have to see, with what kind of speed that happens. Everybody's been talking a lot of trash about Donald Trump's drill baby drill, and they say, oh, that won't actually increase oil production. And I think just naturally this cycle was turning on its own anyway, but the rig count is growing again. So that should be good for ProFrac Holdings. And it's, you know, it should be positioned for a pretty explosive move here. I mean, it's all the moving averages are pretty tight together. Looks like it's starting to turn up again. But this has been painful for these last 2 weeks also. Let's see. What is not improving is the offshore drillers. All the offshore drillers, it's just nothing but pain. And it's not just these last 2 weeks. This has been a straight line down ever since the middle of January. Oh, it's kind of amazing. Transocean's at $3.04. I didn't think we'd see that price again. I think I first bought in at $2.52. How long ago was that? Wow, is that 3 years now? Yeah, so this is about the period where I bought it when I first found it in 2020. It was one of these two dips because I bought it at $2.52. Now I bought more of it at prices that are not very good now in hindsight. But what's amazing is that they landed a bunch of high value contracts, but it takes time for those contracts to be activated. And they have an $8.3 billion backlog of higher value contracts that are still to roll on. This company has 2 years of accelerating earnings from here, and it just can't catch a bid. I mean, this is just pure pain. And it's not exactly clear why it's so hated. Because it's in the oversold territory. I don't know if this is going to put in a bottom here or not. There's not really an obvious resistance line here. It's kind of in no man's land. But again, they've got very little white space on their order book for 2025 and for 2026, and it's going to be cash flow positive. They have some amortizing debt, but it's doing fantastic. They only have to worry now about booking contracts for 2027, and oil is still the most important global commodity, and the order book for these ships is completely empty. Nobody's going to order a new drill ship, especially not at the current day rates. And if they did, it would take 5 years to be delivered. So I think this price is too cheap for this company. But I bought some at $2.52, and I bought some at $5, and I think I foolishly bought some at $8. And being at $3, it doesn't feel very good. But I'm still convinced that within maybe 5 years, this is going to be a $25 stock. But what a painful journey. Vermilion Energy. Wow. That's maybe a quadruple bottom bouncing off this $8.50 point. Let me go back to so this, it looks like a quadruple bottom here. And if I just had to guess, it's bouncing off of oversold. It could turn up from here. This has been another painful one. This has been painful because people don't like Canada. But what's amazing about oil in Canada is because of the exchange rate, it might be a little bit lower than that, but for most of this year, oil's been over $100 Canadian, and Vermilion Energy's debt is in Canadian dollars. So they're making $100 a barrel to pay off Canadian denominated debt. It really doesn't matter what the US dollar is doing. It's in a fantastic position. And they just did a huge acquisition. I think they're going to increase production by 40%, and you'd never know it by looking at the charts. They don't have, I think that's a quadruple bottom. That's showing a lot of resistance at the $8.50 mark, but that's an inverse hammer candle, right? This is closing, it tried to break out today and it gave it all back, which is not a great sign. What else? Portillo's had an earnings call that the market liked, but then it's given some of that back. It's just an odd time in the market where if you disappoint on earnings, you get sold off by 10, 20, or 40%. And if you beat on earnings, you're probably kind of flat. And Portillo's had a beat. They were opened so many new locations, and they had a growth in same-store sales, which they had guided to. So Portillo's doesn't do promotions. They do everyday value. So when their competitors are desperate and putting on sales, it takes away from Portillo's volume, because Portillo's is already priced for everyday value, there's really no room to run any promotions or sales. So seeing the year-over-year same-store volume increase was very positive. But it rallied on earnings and then gave it most of it back. Yeah, it's consolidating. I don't know where it'll go next, but it's going to be opening. It's going to be growing store count 11 or 12% a year from here on out. And then just as you have inflation, and this is not debt fuel. This is just from cash flow. So you're going to have anyway. I think it's a fantastic company. I have a paywall right up on my Substack. Sibanye Stillwater. Oof. This is another one. But so in defense of Sibanye Stillwater, they did something that was very good. So they stopped funding for their Rhyolite Ridge lithium project. They still have the Keliber lithium project in Norway, but they decided they didn't need 2 lithium mines as a platinum miner. So the CEO of Sibanye Stillwater wanted the company to be in 3 buckets: precious metals, platinum group metals, and battery metals. And so they had done a couple lithium projects, and they, because of the low price of lithium, without really much look forward to lithium prices improving, they scrapped their second lithium project, which is good news because that's going to be stopping the bleeding of cash flow out on that project. And so I was listening to the earnings call of Hoeg Autoliners, and they said that volumes of cars shipped from China to Europe was surprisingly strong. And it was surprisingly strong because China was able to, in the blink of an eye, rejigger their production to switch from electric vehicles to hybrid vehicles. And those hybrid vehicles, so again, Europe put tariffs on electric vehicles from China, and China just switched to hybrid vehicles, and the exports are still high from China to Europe. Well, every hybrid vehicle has about 15% more platinum group metals than a traditional internal combustion vehicle, just because of the temperature the catalyst runs at. So, I mean, China's manufacturing the heck out of hybrid vehicles and exporting them, and the platinum group metals miners can't catch a bid. And that's a painful price at $3.19 for Sibanye Stillwater. There is a lot of pain in this market, and they have about 700,000 ounces annually production of gold, and the gold price is staying high at about $2,900 an ounce. Equinox Gold did an acquisition. They did a merger. It wasn't of equals in size. It was a merger of equals in the fact that nobody got a premium in the merger. It was a stock-based merger, and neither side got a premium. So they just merged with Caliber Mining. And the management teams of both companies believe that if you're over 1 million ounces annually of production, you get a higher multiple. And then that could be true. But for the gold price to be hitting $2,900 an ounce, and for Equinox still to be pretty much, when you could have bought it at $628, April of 2024. So the price is relatively unchanged almost for a year, and the gold price has been soaring this whole time. It's pretty amazing. Let's see. There's a lot of smaller companies to go through. For the most part, most things have sold off. Very few things are doing well for these last couple of weeks. Let's see. The only things that are really doing well right now are some small cap tech names and gold miners. Aside from that, if you're pharmaceutical, you've been trashed. If you're logistics, you've been trashed. If you're consumer discretionary, you've been trashed. Let's take a look at some of the home builders, because interest rates are falling, right? The 10-year Treasury has gone from 4.5 down to 4.25. So if anybody would benefit from that, it would be the home builders. And Beazer Homes is still not looking fantastic. What about rocket companies? Rocket companies is still looking pretty good. They had that huge sell-off, and then they bounced off the bottom, and that's upward momentum with interest rates falling. So I like rocket companies here. What about Douglas Eliman? Douglas Elliman similar, right? It's not looking so terrible. So that's maybe one of the only corners of the marketplace that is somewhat attractive. How is SoFi doing? SoFi, it still is the bull flag in the consolidation period. It's starting to get towards oversold. Let's see. Yeah, I mean, everything has been getting sold off so aggressively. JAKKS Pacific, they sold off. They were at 35, and in these last 2 weeks, they're down to 26. And they just had a beat on earnings. I think they earned $3.76 a share for the last year. So that was down to a PE of 8. And this last year was a weak year because, so JAKKS Pacific, it's a toy manufacturer. They have their, all year long toys, but they win contracts to do merchandise for movies. And whenever there's a good children's movie, they sell a lot of merchandise. And it's not when the movie's in the theaters, it's when it switches from the theaters to being streaming. When the children's movies leave the theater and go to streaming, they sell a giant pile of merchandise if it's a good movie. And 2024 was still suffering under Disney's Wish, which was a terrible movie and didn't drive any merchandise sales. But they're looking forward to 2025. You have Sonic 3 and Moana 2. If I go to Rotten Tomatoes, so Sonic 3 is the highest rated video game movie in history. And that's moving to streaming now. So it's got a 95% popcorn meter and an 85% tomato meter. And how's Moana 2 doing? Moana 2, slight, weaker than Sonic 3, but still very popular with the fans. So 10,000 popcorn meters, 86%. So again, they earned $3.76 a share in the year where they were burdened under Disney's Wish falling flat on its face. And looking forward to 2025, you've got Moana 2 and Sonic 3 that are just going to drive outrageous merchandise sales. I'll go to JAKKS' website. And they make the toys for, not all of them, because the manufacturers kind of split it up across toy manufacturers. I really don't know anything about Dogman, but the Moana 2 merchandise and the Sonic 3 merchandise should be pretty popular. In 2027, Frozen 3 comes out. That's for Frozen movies are huge merchandise drivers. Let's see. They've got, let's see. Yeah, I don't know anything about Dogman. But Sonic the Hedgehog, let's see, what's the Sonic merchandise? This is going to be for Moana 2. So anyway, yeah, the Sonic, their theme for JAKKS Pacific is their toys they try to keep within the $20 to $50 range. They try to be one of the lower cost toy manufacturers. But again, the Sonic 3 and Moana 2 merchandise, it should be a pretty good year for JAKKS Pacific. And it just, I mean, I think it had pretty good earnings. They became completely debt-free. They retired their convertible bonds or their preferred stocks. There's no limitation to return of capital to shareholders. They started a $1 a year dividend, which is not my favorite use of capital. I probably would have preferred a share buyback. Gosh, look at how fast it went from overbought to oversold. That's just shocking. What is that? From the middle of February, right? These 2 weeks. And this is why even, and this is a company that's, doing fantastic. They've been doing nothing but positive things fundamentally for a few years as they pay down their debt and they pay down their preferred stock and they reinstituted a return of capital to shareholders. It's just nothing but good things. And it got cut from 35 to 26. It's just kind of amazing. It's not below its 200-day moving average. I don't think it'll fall that far. But it's a good company. And let's see. It's really, their earnings are really tied to when there's a good movie out. In 2021, when there was Disney's Encanto, they made, I think, they had earnings of about $10 a share. So if there's a really, really strong children's movie, they earn $10 a share. If there's decent children's movies, they'll earn $5 a share. And if there are bad children's movies, they'll earn like $3.50 a share. And 2024 was a year with bad children's movies. 2025, I think, is going to be a year with pretty good ones. My boy is 2.5, so he's not watching Sonic the Hedgehog. But again, to have the most popular computer game movie of all time hitting the streaming this spring and merchandise, flying off the shelves all year, and for that to be at the same time as Moana 2, so you've got something for the boys and something for the girls. I don't know. I would not be selling JAKK specific here, but the market disagrees with me. Well, I think that's all I've got for today. It has been a painful couple of weeks. I mean, just the number of stocks that get chopped into pieces like this. JAKK specific, Newell Brands. It just feels like the Boston Strangler is working its way around the neighborhood, and just every day it picks one of the stocks in my portfolio to knock it down 20, 30, 40% in small cap land. It is just a very painful process. And they haven't started turning up yet, so the sell-off is still underway, but the sell-off is getting old, right? I mean, look at Newell Brands. It's been oversold now ever since the start of February. And the MACD is getting close to turning up again. So I think a lot of these things are pretty close to catching some positive momentum. For right now, the only thing that's working, well, just starting today, energy was working. But aside from that, if you're not in some small cap tech names that are really aggressively growing, or gold miners, it has been a rough February. And we'll see how March does. March can suffer under the selling as people raise money to pay their taxes. And then you have sell in May and go away. But I think 2025 will still be a strong year. But yeah, when the fear and greed index is on extreme fear, and when the VIX is over 20, when you're in a bull market, just raise some cash and buy something. That's really the best thing to do right now. Because all these companies below their 200-day moving average, Newell Brands, I think 6 quarters into their turnaround story, and they've been having continuous improvement for 6 quarters. And they're back trading at where they were trading at last June in that sell-off. So it's just amazing. Anyway, thank you guys for listening, and hopefully there's some more positive news next week. There should be, because the 10-year Treasury is falling, right? 4.25 on the 10-year Treasury should be able to support the markets a little bit. Once this sell-off loses momentum and it's time to buy again, we now don't have those interest rate fears in front of us. So anyway, thanks for watching. I hope you guys have a great day.